stock of the day though, instead of our usual stock of the day, we'll be doing a chart of the day, focusing in on, Carl, what are we going to focus in on?
Yeah, so I thought we'd look at the XJO, the ASX200, and to get a top-down view, and then we can drill down to some stocks. So I've got my chart of the XJO, which probably viewers are pretty familiar with on my Friday segments, my lines and bells and whistles and things like that. But the key here, I think, for the ASX200 is that we are at a pretty important balance point. So for me, technical analysis, charting is all about understanding the balance between supply and demand. Supply, demand interacts, gives us price. And, it's the oldest rule in economics that when supply is greater than demand, prices tend to go down. When demand is greater than supply, prices go up. What we're seeing right now is the third potential scenario, which is supply and demand are relatively balanced, and you get this sideways pattern. So the best time to be in the market, the easiest time, is when you've got that dark green zone going bottom left, top right, as you often hear me saying. And that's when we have overwhelming demand. It's buy the dip, bull market stuff. We get to a point where the macroeconomics change. And really, if we look at sort of late last year, it started to become about interest rates. We went from this narrative that inflation was transitory, remember that line, to, well, it's something more sinister that central banks need to deal with. So it's not so much that central banks started jacking up interest rates, it was more about that the market started jacking up interest rates. So we went from, around about 1% to, over 3%, for example, on those long-term bonds. And that just put a huge handbrake on expectations for earnings, on what investors will pay for stocks compared to other asset classes. And you can just see it just creates, not only does it create supply, but it reduces demand at the same time. Two factors there working to cause that equilibrium. I think we should be grateful though, because many other markets around the world have moved into significant downtrends and in some cases bear market trends. So I think we actually should be grateful that we've only gone sideways. Look, that's the broader environment within which investors right now, viewers, are having to invest their money to deal with. So long story short, those easy times are gone. You've heard me say this a number of times, and now this is where the cream rises to the top in terms of investors and stock pickers. And I'm sure investors, viewers, have seen parts of their portfolio absolutely go down the toilet, let's face it, and other parts hold up. And they need to understand why. And you need to make that transition from that buy, hold and hope to being a little bit more active and just weeding out some of those stocks that are turning that momentum. Go and have a look at all those stocks that are now in the toilet. They all started off like this XJO chart. That's the message. They all started off with the uptrend. They all went into equilibrium and then they turned down. So that's when you want to be active and start to prune them out and then keep the ones that are still dark green zone. The ASX200, I'm a little bit concerned. I think we're just starting to just lose that grip on the fingernails there. I'm worried if we get below 69.30, I think that would, it's going to be hard for me not to say we're in a long-term downtrend from there, and certainly below 67.58. That's the bear case. The bull case is we get ourselves back above 72.89 quick smart, and then potentially we can move up to those highs. So very crucial level.
69.30.
How
do you get that figure? And 67.58 on the screen now. So 69.30 is the first test, and if it drops below that and drops below 67.58, we're certainly in a bear market. That's what you're saying.
So we're looking at places where demand came in for whatever reason. And for me, the reason is not important, but demand was there. So we know demand is latent in the system. It was there. It doesn't mean it's there next week. Here's the thing. If we get down there and we break through that level, that demand's gone. Why is it gone? I don't want to know, but it doesn't sound good. Right. And there's enough supply to push you through that level. That's this whole idea of support resistance, not just lines on charts. They're levels where investors put their money, their risk on the line, and if they're gone the next time you get there, that's a bad sign.
So that's where it bounced back last time, and to see if the all right, Gary, you have the same chart, do you? Ken?
Yeah, I have a similar chart, but probably slightly different view from Carl here. So, look, I agree with Carl. I mean, really, we really just need to be looking at price and volume. Those are the two really key ingredients. We've got lots of other bells and whistles we can use in charts, lots of other indicators, but if we're looking at price and volume alone, that'll sort of, the great traders, good technicians, they'll look at these sort of key things here. So I've kept this chart pretty simple here, Koshi. So we can see here with this current rally that's going on there, see how I've put an arrow there with what I call sort of wide up days off the lows here.
Yeah.
And some of those days are accompanied by some of the lightest volumes that we've seen here.
Right.
And look at our sort of three sort of down days, sort of like what we call sort of selling days.
Yeah.
And we see the volume almost double what we're actually saying here. So every time we sort of get to a high level and then we see a sell-off, we're seeing what we call distribution type volume there. So
it's a big sell-off.
So NASDAQ's doing the same thing, S&P is very similar. So we're rallying on really light volume.
Right.
And every time we face a little bit of a hit and we start to sell off, the volume really picks up here. So as Carl's sort of getting a bit worried about this market, the volume dynamics here, the distribution, is indicating that this is not a very strong market. All those rallies are on very weak. So it just basically means
Okay, so there's no conviction in a rally.
100%. Yeah.
But that backs up what Carl's saying, because he's saying there's a weakness on the downside. You're just coming at it from a different level.
Just looking at the volume as well. So I think there's actually a little pennant there.
Right.
So I haven't actually drawn the lines in there, but if we drew the lines up through the lows and through the highs there, there'd be like a little pennant.
So it goes like that.
Yeah, and
What does that mean?
Well, normally we want to stay on that trend, sort of maintain it, but we've actually broken through the last couple of days.
Okay.
And more importantly, we've broken through with some really strong volume. So that's distribution type volume. We've seen the banks sell off here pretty aggressively, pretty heavy volume.
Right.
Commodities are sort of holding the index up here at the moment.
Yeah.
But the chart here is pretty negative. It's funny, we're just sort of seeing really, really light volume there. We're sort of, on that, I showed here, I think it was the 28th of sort of February there.
Back to 28th of February.
Oh,
I see that green bit.
Yeah, so that you can see here, that was the day after the low. And look at the volume there. The volume was double the previous sort of selling there. Right. So really sort of got what we call like a follow through day. So when you see a big
and
move,
you put the green thing about those lines at the bottom there,
that's
or
right,
second from the bottom, the lines going out is the daily volume. Oh,
that's right. So we can see massive volume there on that reversal day.
Right.
So that would actually, if we're waiting for a low and we saw that massive volume come in, that might give us the confidence to sort of, wade into the market.
Right.
And then when it pulled back again, we saw some pretty strong volume buying that dip.
Yeah.
And then once we sort of got a little bit higher, we started to see the volume, as we got higher and higher, the volume started to taper off. So therefore, we're getting pretty stretched, gun retesting the old high, and we see volume is now reduced, probably half the average.
Yeah.
So again, you just got to look at these sort of distributions. So volume really can tell you a lot about the conviction of our buyers and sellers in the marketplace.
Carl, you agree with that?
Yeah, look, volume is another key part of what I do. So you've got a couple of styles of technical analysis, probably worth discussing now. I'd love to hear Gary's opinion on this, but you've got your prognosticating technical analysts. So they're using a lot of Gann theory, Fibonacci, and Elliott wave. How about that? Go Google those things. But they're looking to use these technical analysis methods to predict points, dates, and prices into the future where things might happen. You might get a turning point. Then you've got me. I'm in the other camp. So I'm a reactionary technical analyst. I use indicators, moving averages, and ultimately they're all delayed. It's like driving a car looking in the rearview mirror. You can only see what's happening in the past. But I'm looking looking at price, looking at volume to understand what those supply-demand dynamics are at any point in time. Right now, am I seeing that there's more demand in the system and I should be allocating capital to the market? Is there more supply in the system? I should be pulling back, or is there equilibrium? You can still invest, but you have to be in the right sectors. So I'm a reactionist. So what you could see is that I could put up a chart today and I say it looks fantastic, but next week my opinion will change because the price action, the dynamics have changed. So it is a reactionary form. You'll never get in at the bottom, you'll never get out the top, but that's not what I'm trying to do. I'm a trend follower, so I try and capture that meaty part in the middle. I let the trend establish itself. As you've heard me say in the past, Koshi, I think there's a great stock here. It's a great story. I love the stock, but I can't buy it until the trend turns up. And often I'll hold past the top even. So I'll miss the top because I'm waiting for the trend to come down the other side before I get out. So it's the probability, the success for me lies in that chunky part in the middle, the trend.
Gantt, Fibonacci, that takes me back to my old Dewey economics days at uni. Are you a reactionary or a...
Look, I actually have studied all those theories. So some Gann, Elliott wave, even studied like sunspot activity, which is really left of
sunspot activity.
Yeah, so there's a theory around...
You'll be wearing beads and lighting candles around.
The problem with those theories is you're sort of hard to trade.
Yeah.
And I've probably moved more into Carl's camp as well. Right. And the best traders just keep it simple.
Yeah.
They really just sort of, the thing I like about Carl is I know that, it's bottom left, top right. He's looking at relative strength, so he's trying to, look at the strongest stocks on the board and trying to go with that momentum. So a lot of the best performing traders do follow that method. So I've definitely sort of moved to that method in the last couple of years, more so. Because the problem is you become, if you're a master, if you're jack of all trades, you don't. They're not the traders who are the most successful. It's the sort of mastering. A method there. So you've got to find your edge in the market, your what they call a playbook. So really looking for a certain sort of small number of setups, and you just trade those setups and you become a master of those setups, and then you just keep following that technique and stuff there.
All right.